Hello everyone. Welcome to my channel, the Cheryl Hubbard Show, right here on YouTube. Well, I'm doing a little something different today. I usually do my entrepreneur segment, but today I just want to go over a few little accounting tips from just want to show you a few little things that I learned down straight at university when I was working on my business administration degree, and one of my courses I took, one of my courses I had to take was accounting. I think I took maybe about 2 or 3 accounting courses. I think I know I took managerial accounting, and I took, regular basic accounting, managerial accounting, financial accounting. So those are the courses that I had that were required of me in my major, business administration. I did a bachelor's in business administration. So I just want to go over a few little things. I'm not an accounting teacher, but just want to, touch base on a few things. Like I said, I usually do my entrepreneur segment, so you may know me from on my channel, on my entrepreneur segment. I usually talk about Shirley Cosmetics. So what I want to do, I want to talk about a few little accounting, a few little accounting terms, a little accounting, just basically go over a little accounting. Just a little, the basics of accounting. I guess I would call it that. Okay, first of all, we want to know, what is accounting? Accounting is a system that measures business activities, processes that information into reports, and communicates those results to decision makers. So in other words, if you are a business, whether you're a big business or a small business, you might want to have an accounting department. So you may have somebody work for your company that's that may do your accounting paperwork, your accounting statements, your accounting books, however you want to call it. Or if you're running a big corporation, you might have to hire a big accounting firm to help you with your accounting statements, your accounting records. So one of the main purposes of, I guess I would say one of the purposes of accounting information, generating the accounting information, is so decisions can be made. So in other words, you running a company, say for instance, my company Shirley Cosmetics. So I need to make sure my income statements, my balance sheets, my statements of owner's equity, I have to make sure all those statements are accurate. So whether or not I have an accounting firm doing my accounting books or doing my accounting statements, or whether I'm doing it in-house. So I still need to make sure my paperwork is accurate. All my statements, statement of cash flows, statement of owner's equity, statement of the balance sheet, income statement, and so I want to make sure those statements have accurate information. So we have accounting. I just explained the definition of accounting. So we also have financial accounting and managerial accounting. So financial accounting is for those outside decision makers. Financial accounting is for the outside decision makers, your SEC, Security and Exchange Commission. They have to make sure that your books are accurate, because if they have, if your company is ever audited, you have to make sure you have accurate accounting statements. Your accounting paperwork has to be accurate. So like I said, whether or not you have an outside firm, you want to outsource, have a firm do your accounting books, or you having it done in-house with the accounting department. So we have the financial accounting, which is, like I said, the outside decision makers. Then we have the managerial accounting, managerial accounting. That is the inside decision makers, like your managers. Your managers need information inside what's going on. Hey, what's going on with our organization? What's going on with our corporation? So they need to make decisions. They need to know, how much did we make this year? How much did we make this accounting cycle? How much did we make this accounting cycle? How much did we make this year? Or how much do we need? We want to put a new We want to put a new roof on our building. We want to add a new wing. We want to hire some more employees. We want to buy some new machinery. We want to buy some more. We want to invest in some more products. We want to expand our product line. So how's the company doing? Do we have enough money to do those things? Do we have enough money? And what if we want to get a loan from the bank or the credit union? They want to know how the company is doing, because they gonna want to look at your income statements, your balance sheets, your statement of owner's equity, because they want to know, y'all want to borrow, y'all company wants to borrow this money now, can y'all pay it back? So that's what they want to know. So that's financial accounting and managerial accounting. So who else needs accounting information? Individuals. You running a business, like I said, you need accounting information for your business. You're a regular individual. You want your basic accounting books at home, like me and a million others. We all are paying bills and buying cars and buying houses. So we still want to know what I guess we can say what our income looks like. What our income looks like, what we have coming in, what we have going out, our cash flows, uh, money coming in, money going out. So we want to know, how are we doing? And then we have the investors, the creditors. Definitely want to know, like I said, if you say, for instance, you like company, like you could be your own company, like Shirley Cosmetics or McDonald's or Wendy's or any company that you can think of. What if any of us wanted to borrow from, credit union or bank or something like that. What if we want to borrow some money? They're gonna want to know how is this company doing? How is she doing? How is he doing? How is McDonald's doing? Can we let what if McDonald's they probably do it all the time. They probably purchasing their hamburgers. Say for instance they want about say for instance they want to buy $1 million worth of hamburgers, $1 million worth of hamburger rolls. So they gonna be looked at based on their credit, their credit history. So 9 times out of 10, McDonald's will have the credit. McDonald's, Wendy's, Burger King, Checkers, what's it? Checkers, Church's Chicken, and all the different places. So it's investors and creditors. They provide the money. So when they provide the money to the business they need to begin with they need to begin the in other words if a business needs to borrow money to begin their operations. In other words, the bank is going to look at how is this person doing or how's the company doing. So it says a loan. As a loan, the banks will determine if they're going to determine the borrower's ability to make the payments. So in other words, to pay us back. So that's what I was saying. They want to know are they able to pay us back? A lot of times you go to the bank and you say, you could be working and you can think you qualify, and what if you say, hey, I want to just give me $1,000 loan, but I work every day. I generate taxes. I want to give me $1,000 loan. So sometimes banks are a little hard on you, when it comes to trying to borrow money. But sometimes you may, be able to go through them, finance a car, finance a house. But a lot of times they will look at your credit and they're going to look at your money you have coming in, income you have coming in, income you have going out. Because that's why they always ask you on applications, credit applications, if you're trying to borrow money, they want to ask you what's your income, and they want to ask you what is your rent. What type of rent do you pay? Do you rent or do you have a mortgage? And what is your mortgage? What are your monthly bills? So they want to know. They want to look at your total income coming in, your revenues, minus your expenses. That goes on the income statement. That gives them your net income. So that way they can say, well, you know what? Maybe he or she or this company, they have too much debt. They have too much debt over their expenses. Too much debt over their revenue. They don't have, I don't think they're going to be qualified to pay this money back. So we have, like I said, government regulatory agencies, the SEC, taxing authorities, nonprofit authorities. These are outside. These will come under financial accounting. And they also had the generally accepted accounting principles, the methods that identify the proper way to produce accounting information. So in other words, you have rules and regulations when you're producing. If you're an accountant or you work in an accounting department, there's a certain way that you have to, you have to. In other words, you have to go by certain rules and regulations and certain methods when when you are creating those accounting statements. I guess income statements, balance sheets, statements of owner's equity, and then another thing. When I was at Australia University, what we did, we talked about, first of all, we talked about what is accounting. Then we talked about the different agencies, like I said, that need accounting information. Like, who needs accounting information? So I just went over that. And then you want to know what accounting is. You want to know who accounting is. You want to know what accounting is. You want to know who needs accounting information. Then you want to know, then you want to learn about then we learned about liabilities, uh, assets, liabilities, revenues, expenses. We learned all those terms before we got to the T accounts. So first I'm going to start out with the initial accounting equation. The initial accounting equation is assets equals liabilities plus owner's equity. So I just put OE. Assets equals liabilities plus owner's equity. That's the initial equation, accounting equation. So what is an asset? Assets are economic resources, are the economic resources of a business that is expected to be a benefit in the future. So in other words, an asset, you have land, you have buildings, you have machinery, you have your big mainframes, your supercomputers, your mini computers, supercomputers, and your mainframe. So those are your big, your big equipment. Your big equipment that you may have in your building, in your business and your building. Also, you have buildings, you have in your business that will generate future value for you. So in other words, assets, economic resources of a business is expected to be a benefit in the future. So in other words, if you got some big mainframes, you have some big supercomputers, they will benefit you in the future. You have some land, you have a business and you purchase some land. You purchase that land. That land could be what you are going to use to expand your business. You might want to add 4 or 5 different wings. You want to hire more employees. So that will be a future benefit to the company. So that's what an asset is. Asset is something that can give you that future value. So you don't want to buy assets. Wouldn't be nothing like if you buy 5, 6 pair of Jordan tennis shoes or Nike tennis shoes or 4 or 5 pair of jeans. They don't have no type of future benefit. They don't have no type of benefit for you in the future. So they're talking about land, machinery, buildings, like I said, the big mainframe computers, even inventory. Depending on what type of inventory you have, that could also give you future value. And then we have liabilities. So let's start out. We have assets. Now let's talk about the liabilities. The liabilities are your debts. Whatever debts. Like I said, McDonald's, if they create a credit account with, say for instance, a place they call Hamburger Land, just an example. And they say, well, look, I want $1 million worth of hamburgers, but I don't want to pay you all right now, all at one time. So they're creating a liability. That's a debt. So McDonald's, they're creating a accounts payable because they're going to have to pay. They're going to have to pay in the future because they may say, well, we'll pay it off in 30 days, or we'll pay it off in 60 or 90 days. So we want, a place called Hamburger Land. We want $1 million worth of hamburgers. So that creates a liability for McDonald's. McDonald's wanted to buy $1 million worth of hamburgers and the hamburger rolls from a place called Hamburger Land, but they didn't pay. They didn't pay for the. They created a credit account. They didn't pay all of that at one time. They didn't pay for it at one time. What they did, they created accounts payable for that company. So accounts payable is a liability. So, like I said, the example was McDonald's. McDonald's promised to pay from the purchase of meat. When they purchased their meat, they promised to pay on credit. That created debt for the restaurant called McDonald's. And anything, my company, Shirley Cosmetics. So what if I wanted $100,000 worth of say my jars and my lip gloss tubes, I have my Arby Hagel Balm for children, and I have my Kenneth Senior Boss Man Hair Growth Balm for men, and then I have my another product called Grow Your Hair Girl, and that is a balm. That is a hair growth balm for ladies, girls, women. So what if I went somewhere and I went to this place called Variety Central, just make up a name, Variety Central, and I tell them, I want to create a credit account for my business. I'm not gonna be able to pay all this at one time, so I want to create this credit account. I need about $100,000 worth of mixed supplies. I need my jars. I need my lip gloss tubes. I need my base. I need various items for my business, but I want to create a debt. So I would be creating a debt. I'm not gonna pay for it all at one time. So I would be creating a liability, which would be a debt for my company, my company called Shirley Cosmetics. So I might say, hey, well, let me give y'all $100,000, let me give y'all $20,000 down, and I pay the rest in 30 days, So I just created a debt. So that's what they call a liability. So I would be creating accounts payable. So say, for instance, I'm creating accounts payable, and erase this. So if I'm creating an accounts payable, say for instance, when you come to accounting and you're doing transactions, each transaction usually affects two accounts. So in other words, like I said, I wanted $100,000 worth of items. I wanted to buy $100,000 worth of items, but I want to buy it on credit. So I will be creating accounts payable. I will be creating accounts payable. Accounts payable, $100,000. So in other words, when you create an accounts payable, you want a credit on the right-hand side for increase. So I'm increasing my accounts payable. This is the debit side, this is the credit side. So these are what they call T accounts, shaped just like a T. So when it comes to a liabilities account, you want a credit on the right for increase. So I'm increasing my liabilities account. I purchased $100,000 worth of items for my business, Shirley Cosmetics. Shirley Cosmetics. So, and then I have another account I will call inventory. See, so I bought $100,000. I bought $100,000 worth of inventory. So what I'm doing, I want to increase my inventory account since I bought it. $100,000 worth of inventory. I want to debit my inventory account on the left. See, so when it comes to an asset account, you debit on the left for increase. But when it comes to a liabilities account, you credit on the right for increase. So I increase my accounts payable, which is a liabilities account. I increase it on the right for $100,000, and I increase my asset account. Inventory is an asset account. Like I said, I was just telling you, all asset accounts are accounts that give you future value. In other words, you buy 6 cows, 50 cows. You buy land, you buy buildings, you buy bulky inventory, machinery, mainframes, supercomputers. All those are assets that will give you future value. Like I said, you can't buy those 4 or 5 pair of tennis shoes and think that they're going to give you some type of future value, because they won't. So that is that one. So that's accounts payable. So that's accounts payable. And so just wanted to explain that a little bit, And so let's move on. Let's see what I have next. So then we have and then we have revenues. The revenues are your amount earned by delivering goods and services to the customers. So then we have so let's start out right here. First we had assets, we had liabilities. We had assets, we had liabilities, and we had revenues. And then we have expenses. This is some good chalk right here. I bought this chalk, this outside playground chalk, see? Outside playground chalk. So it's good. It writes good and strong for the board. Okay, so I went over assets. I went over liabilities. So I talked about revenues, amounts earned by delivering goods and services to customers. That's, in other words, revenues. You running a business. Say, for instance, you running a hair salon or barber shop, and you're providing services to your customers. You're providing services to your customers, and that is how you generate your revenues. The revenues, amounts earned by delivering goods and services to customers. So you're delivering goods. Like me, Shirley Cosmetics. I'm selling my lip gloss. I'm selling my lip gloss tubes. I'm selling them, and I'm marketing my hair growth balm, my body butters. So I'm generating revenue. Which they have to take taxes out. So then at the end of the year, you file your taxes. So then we have our expenses. Expenses decreases in owner's equity, increases in owner's equity, and it occurs in the course of delivering goods and services to the customer. So in other words, expenses, your expenses would be like, your rent, your electric, you have to pay your employees. All those will come out of expenses. I have to pay my employees. I have to pay my rent. I have to pay my electric bill. I have to pay my gas bill. Whatever expenses I have, whatever bills I have will come out of my expenses. Will be considered my expenses. So, okay, so I explained assets. So assets are I guess I would say there's something of value that you can use that can give you some future benefit. Then you have your liabilities. In other words, you running a business and you want to borrow some money, or you want to buy some products on credit. You're creating a liability. You're creating a debt. Your revenues, money earned. In other words, you have your revenues. You have, like I said, you have a salon or barber shop or something you run it, or even a regular variety store. You have a variety store, and you have people, you're selling goods and services. You're creating revenue. You're creating revenue when you cutting somebody's hair, putting a perm in somebody's hair. All that comes under revenue. Your expenses, like I said, you have to pay your employees. You have to pay, what are your expenses? You have your electric, you have your gas. You have a light bill. You have whatever bills you have, whatever expenses you have in the course of operating your every day, day-to-day operating, the day-to-day operation of your business. So that would be your expenses. So, and like I said, the initial accounting equation is assets equals liabilities plus owner's equity. So that is the initial accounting equation. So in other words, I'm running a company called Shirley Cosmetics, and I want to, say for instance, I'm just starting out. I'm just starting out, and I want to say for instance, I want to invest $50,000 in my business. I just started out and I want to invest $50,000 in my business. So, like I said, you always have two T accounts. In other words, I'm running my business. I want to invest $50,000 in my business. So what I want to do, I want to create an account for cash. I want to put this $50,000 into a bank account for Shirley Cosmetics LLC. Shirley Cosmetics LLC. I want to start my business out with $50,000. So like I said previously, when you have an asset account, you want to debit on the left for increase. So since I'm depositing $50,000 in the account, Shirley Cosmetics LLC. So I want to debit cash on the left for $50,000, and then I have owner's equity. Since I'm increasing my owner's equity, that'll be $50,000 too. So this is the debit side and it's the credit side. So we always say debits on the left, credits on the right. So we want to credit our owner's equity account $50,000. Credit owner's equity account $50,000, and I want to debit my cash account $50,000. So cash and owner's equity will come under your asset accounts. All your liabilities accounts will be all the debts that you owe. You have assets, you have liabilities, and that will determine how much owner's equity you have. So for instance, I invested $50,000 in the business, and I debit cash $50,000, credit owner's equity $50,000, but I want to go back. I want to go back to the business bank account. I want to take out that $50,000. So just an example, I deposit $50,000, but I want to go back. I want to go back and say, for instance, I want to buy some supplies. So we want to say supplies. Say, for instance, my cash account is $50,000 I had in it. My cash account this is initial deposit in Shirley Cosmetics LLC. So Shirley Cosmetics LLC, my initial deposit, previous transaction, $50,000. So I want to debit. So remember, you got D on the left and C on the right. So I want to debit my cash $50,000 because this is the $50,000 I initially deposited in Shirley Cosmetics LLC's bank account. So I created an account, Shirley Cosmetics LLC. So what I want to do is buy, say for instance I want, then I'll take this off. That's just showing you the $50,000 that I put in the account. But what I want to do, I want to buy some supplies now. So my supplies cost me now I want to buy $50 worth of supplies. I want to buy 50,000. I put 50,000 in cash, so that would be a debit to cash. But now I want to take out. So if I debit the cash for increase, now I want to credit cash for decrease because I want to buy some supplies. Say for instance, I want 10,000 in supplies, but the 50,000 can still stay over here because that's initial deposit. But if I want to take out, I want to credit on the right hand side. So that'll bring me down to 40,000. That'll bring me down to 40,000 left in my cash account. And I purchased $40,000 in supplies. So that's how I would do that one. So in other words, I already put $50,000 in my cash account. I created an account to start my business, Shirley Cosmetics LLC, $50,000. So I debit on the left for increase. So because I had cash coming into my Shirley Cosmetics account, but I want to take out, I want to credit $10,000 to the cash account because I'm taking it out. This means out. And then that brings me, and then I bought $40,000 worth of supplies. So I increased my supplies account because supplies is an asset. So like I said, you debit on the left for an asset account. Supplies is an asset account. So I debit on the left. So they give me $40,000 $40,000 left. I had $40,000 worth of supplies that I purchased because supplies is an asset, and 40,000 is what I have left for cash because I took out 10,000. I took out 10,000, purchased some supplies. I initially put 50,000 in, so that's how they go. See, I initially put the 50,000. I took out 40,000. I didn't take out 40,000, but I had 40,000 left. I took out 10,000. So that's how I would do that, huh? See all that comes all off. All off. Okay, so that's that was the first one. So I had to let that dry a little bit. And then we have Shirley Cosmetics. So what if I purchased some land. I purchased some land. I put, like I said, see, if I do it all the way down, it'll show you, exactly what I started out with and what I had left, but I do my T accounts individually. So Shirley Cosmetics, it says Shirley Cosmetics purchased land for future office space for $40,000. So I'll just do them individually. So in other words, if I purchased land for Shirley Cosmetics, $40,000. So, like I said, when you're dealing with these transactions, they usually affect two accounts. So, purchase land, and it's going to come out of cash. So, in other words, if I purchase land for $40,000, I want to debit the land account because land is an asset. So, like I said previously, all asset accounts are debited on the left for increase, credited on the right for decrease. And then we have a cash account. So if I purchase $40,000 worth of land, then it's going to come out of it's coming out of my cash account. I want to credit my cash account $40,000 because it's coming out. See, cash is an asset. So like I said previously, to increase your cash, okay, increase means increase means coming in makes it higher. Decrease makes it go down. So D means down, makes it lower it. So in other words, I purchased $40,000 worth of land. Land is an asset. I have $40,000 worth of land. That's $40,000. And I had to pay for it, so it comes out of my cash account. So I'm going to credit my cash account $40,000. So like I said, you credit on the right for decrease when it comes to cash. But you debit on the left for increase. So that is that. That was that one, So then the next one I have, okay, now we have Shirley Cosmetics, buy stationery and other office supplies, agreeing to pay $500 within 30 days. So in other words, Shirley Cosmetics LLC purchased office supplies, agreeing to pay $500 within 30 days. So I am basically creating an accounts payable because I'm agreeing to pay in 30 days. I'm not paying it all at one time. So let me see if I can try another color. Let's see how bright that looks. Oh, that's pretty good too. Okay, so Shirley Cosmetics LLC, I want to purchase some office supplies and I agree to pay $500 in 30 days. So that's going to be a number of accounts. That's accounts payable. So that's 500. I'm creating accounts payable. So like I said, all liabilities accounts credit on the right for increase. So I'm increasing I'm increasing my accounts payable account. So I have one accounts payable account. So that means I'm increasing it. I'm creating an accounts payable 500. So it's going to have to, then I have office supplies. I purchase office supplies is an asset. So since I purchased office supplies, it gives me, I'm creating an increase in office supplies because I purchased office supplies. So when you purchase something, you purchase inventory, that means you're increasing your inventory. I increased my inventory by $500, so I want to debit on the left. I want to debit my office supplies account $500 on the left because, like I said, all asset accounts, you debit on the left for increase, credit on the right for decrease. Then you have accounts payable. See, I'm not paying for it all at one time. Like when you go to the store and you say you have $500 and you pay the cashier $500 cash right there. You paying everything right up front. But when you create accounts payable, you're not paying for it all at the same time. You say, look, I'm creating accounts payable, and you pay later. You're paying around 30 days or 60 days. But when you come back to start paying on that accounts payable, you're going to debit on the left. So in other words, if you since I created accounts payable 500, what if I go back and say, well, I want to pay it up? I created it on the right side. I credited on the right side for 500. So that means that's when I first created the accounts payable. I went back and paid it up, so I debited on the left. I debited accounts payable on the left because I paid it up. So I still have $500 worth of supplies, because that's what I started out with. In other words, if you paid that 500 also, you paid that 500, the 500 could have came out when you went back and paid it, and you paid it up, it had to come out your cash account. So that would be another transaction. In other words, you started out with 500 when you created your accounts payable. You went back and paid it. You went back and paid the 500. You took the 500 out your cash account. I'm going to credit my cash account because when you're paying out your cash account, you credit on the right. But when you have money coming into your cash account, since it's an asset, you debit on the left. So that's how that one goes. So a lot of times it just takes a little time to, go over some of these problems. Because I know when I first started doing accounting, it was a little intricate. It was a little, I guess I would say hard to understand. So, but once I got down in the book and, read, sometimes you have to read over things more than once. Read, keep on reading until you get that full understanding. So the next one is Shirley Cosmetics, Realtor assures. Shirley Cosmetics, this is just a statement here. Shirley Cosmetics, in other words, they're saying that Realtor assures that the land is worth $75,000. The land must be recorded at the purchase price according to the cost principle. In other words, Shirley Cosmetics LLC, I just purchased land for, in the previous transaction, I purchased the land for $40,000. I purchased the land for $40,000, so that gave me $40,000. I purchased the land that was in a previous transaction. So what this statement is just saying is that it said the realtor assures that the land is worth $75,000. But see, when it comes to accounting and the cost principle, you have to record on your books the actual price that you paid for it. So in other words, you pay $40,000 for something, and the realtor tells you that it's worth $75,000, that don't make no difference. You have to write down the actual cost. The cost that comes under the cost principle. So the actual cost is what you paid for it, which is $40,000. I don't care if it's worth $100,000, $200,000, but what you paid for it is what you have to put down on your accounting books. So accounting books have to be definitely accurate. So I just put that statement on there. So that's how that goes. Yes, you have to record it at its actual cost. So later, maybe my next video, I'll go different things. I have some terms in here: the reality principle, the cost principle, and I think I probably already have a video on that. In my previous videos when I first started my channel, but I just purchased these ring lights, so I see that my videos are much clearer. So some of the videos when I first started my channel, I didn't have my ring light, so it might not be as bright as my recent videos. But the next one is Shirley Cosmetics earns service revenue, providing professional accounting services for clients. So my company, Shirley Cosmetics, I'm marketing hair growth balm, body butter, lip glosses. So I have everything. I have all my inventory, and so it's saying Shirley Cosmetics earns service revenue. So I perform the service for my customers, and I collect I collected $5,500 in cash. So I performed service revenue. I performed services and I created revenue, and I collected $5,500 in cash. So that will come under always, like I said, every transaction in accounting usually has two accounts, but sometimes it may have three accounts because I think they call it a double entry. I believe that's called a double entry, but I'll check that out for my next video. So I have cash, and then I have owner's equity. So I received service revenue of $5,500, and then it goes also in my owner's equity account. So in other words, I performed services and I received $5,500. So it says Shirley Cosmetics LLC earns service revenue providing professional services for clients. I provided professional services, and then that comes under revenue, service revenue. So when you're working and making money, you're picking up trash, you're sweeping, that's earning revenue. You're working, you're earning revenue. You're cleaning carpet, whatever you're doing, you're painting, all that is service revenue. You're providing a service. So Shirley Cosmetics LLC, I received $5,500. So this is owner's equity. I just put OE. Owner's equity is how much equity you have in your business. So $5,500 is a cash. So like I said, an asset account. When it comes to an asset account, you debit on the left for increase. So my revenue came in and I earned $5,500. So that was an increase to my cash account, which is an increase to my asset account. So that's that one. And let's see what we have next. And then the next one I have, I think I have like 4 more. Okay, the next one we have Shirley Cosmetics performs services for a client who does not pay immediately. So if I perform services for a client, they don't pay immediately. That creates an accounts receivable for my company, Shirley Cosmetics LLC. But the person that didn't pay right away, that creates an accounts payable for them, and also it goes into owner's equity. So in other words, Shirley Cosmetics, I perform services for one of my customers, $3,000. So they didn't pay right away, so that creates accounts receivable. See, accounts receivable is when, in other words, like I said, you say for instance, you're just selling goods and services. I mean, it could be T-shirts, jeans, or whatever. Somebody comes into your store and they want to pay. They want to pay maybe something down, but they don't want to pay it all at one time. So they create an accounts payable. They're gonna have to pay it later. They're gonna have to pay it within 30 days, 60 days, or 90 days. So And then the company creates accounts receivable, because if you're creating accounts payable and you owe that company, they're creating accounts receivable because they're going to have to receive some funds back from you in the future. So that's why they call it accounts receivable. So you go in there and you say, look, I'm gonna give you, I have $1,000, I want to give you $1,000 down, but I want to buy $5,000 worth of stuff, and you get a company $1,000 down, you owe them $4,000 more dollars. So you're creating accounts payable because you're going to have to pay them in the future. The balance of that $4,000. The company is creating on their books, they will put accounts receivable. So they will put accounts receivable. So if I had Shirley Cosmetics, somebody came in there, they created accounts receivable for my company, but on their books they can put accounts payable, $3,000. So accounts receivable is an asset. It becomes an asset to my company because it don't make no difference if I receive that money right away or if I receive that money in the future. It's still an asset because it's money coming into my company. So that is an accounts receivable, $3,000, and then I have OE for owner's equity. For owner's equity is an asset as well. I would look at it as an asset because it increases your company value. So that is that one. So, accounts receivables, accounts payables, assets, you have revenues. And then, so it's good to learn those terms. It's good to learn those terms first, then you make your way to the T accounts. So let me move along. Shirley Cosmetic pays $2,700 in I guess it's utilities, or I guess it's expenses. Shirley Cosmetics pays $2,700 in expenses. So Shirley Cosmetics pays. So 9 times out of 10, when you pay in expenses, you're gonna pay it out your cash account. So like I said, since cash is an asset, you debit on the left for increase, and I want a credit on the right for decrease. So since I'm paying for expenses, it's going to come out my cash account. So I want a credit on my cash. I want to credit my cash account, $2,700. I want to credit my cash account, $2,700. Let me see if I can make this a little darker. See, so I paid $2,700. Shirley Cosmetics LLC, $2,700 for my expenses. I have office rent, $1,100. Part-time assistant, I had to pay $1,200. And then I had utilities, $400. So that came to $2,700, but it's coming out my cash account. I'll credit my cash account, $2,700. And then owner's equity. Let me see how this white chalk writes. Okay, this is the white chalk. So then I have my owner's equity, $2,700 coming out my owner's equity. So I had $2,700 coming out my owner's equity account. So $2,700, I say cash, credit cash $2,700 because it came out my cash account, and debit owner's equity because owner's equity is decreased by $2,700. So I want to debit on the left side. So then I have, let's see. Okay, the next one, Shirley Cosmetics LLC pays $400 to the store from which she purchased $500 worth of supplies. So in other words, I purchased $500. In other words, I purchased $500 worth of supplies. I had already created accounts. I had already created accounts payable, and I created that $500. So it came out my cash account. It will come out my cash account. So in other words, when I create my accounts payable, see debit, credit, debit. You want debit on the left, credit on the right. So all T accounts are debit on the left, credit on the right for all your T accounts. Just make it like a T. So in other words, I created an accounts payable in a previous transaction because I bought some office supplies for $500, but I didn't pay it all at one time. But now I want to go back and pay $400 on that accounts payable. So what I'll do, I'm going to debit on the left $400. I'm going to debit on the left $400. I started out, I created an accounts payable for $500 because I bought some office supplies for Shirley Cosmetics LLC. I created an accounts payable $500. I went back and paid $400 on that, so they give me a balance of $100 that I owe on my accounts payable to that store. So, but since it came out of my cash account, it has to be $400. So $400 out of the cash account because I took that $400 and paid on my $500 I owe. I owe $500, but I only paid $400. So the balance is $100. Oh, $100. Oh, $100. So that's how that one will go. So I have to purchase me some more chalk. Now, this chalk is alright, but I want some white chalk. I always keep plenty of paper towels for what I want to do. Get some of this off. See how it comes off? That's the color. Okay, so I think I have only two left. Okay, Shirley Cosmetics LLC. Shirley Cosmetics LLC withdraws $2,100 out of the cash, out of the asset cash, out of the cash account. Well, it's an asset account. $2,100. So Shirley Cosmetics LLC. I just put CC LLC. So Shirley Cosmetics LLC withdraws $2,100 out of the business bank account. So cash. So like I said, cash is an asset. So money coming out of the cash account, we want to credit cash. We want to see, this is the debit side and this is the credit side. So if I debit on the left, that means money is increase the cash money coming in. But since I'm taking money out, I'm taking $2,100 out of the business bank account that was created for Shirley Cosmetics LLC, and then $2,100 also will come out of owner's equity. So $2,100 coming out of my owner's equity. So I want to debit. I'm debiting owner's equity. Debit owner's equity on the left. Credit cash on the right. Okay, I think one more, that's it in the book. One more of these are the items that I took out of the book earlier. So it says Shirley Cosmetics LLC. Okay, Shirley Cosmetics LLC. I invest $35,000 into my businesses. It's another transaction. I invest $35,000 in my business. So it's similar to the previous transaction that I went over. So in other words, when you invest money in your business, you have your business bank account set up. Say for instance, Johnny's brick and mortar. Say for instance, he invested $100,000. It will go the same way. But Shirley Cosmetics, I invested according to this 35,000. 35,000. I'm gonna debit my cash account because I'm increasing my cash account by 35,000 because the cash account is an asset account. So this is Shirley Cosmetics LLC, and then it's gonna be, since I'm investing 35,000 in my business, I want to credit my owner's equity account 35,000 because that gives me $35,000 worth of equity in my business, Shirley Cosmetics LLC. So cash is an asset account. So 35,000. Debit cash 35,000. So there you have it for that one. And I think that is the last one that I wrote in here. So, and I think I have a couple of them in the book that I want to look at too. So, like I said, I have a few more minutes. I'm just going over a couple more of these. So, in other words, if you just learning accounting, so those of you that, maybe viewing this video, if you just learning accounting, the best way to go about learning it in the beginning is probably go or read your chapter. Maybe read the first chapter a couple times. Go over those terms. Accounts receivables, accounts payables, assets, revenues, service revenue, accrued, I probably go over the accrued expenses, accrued revenue, accrued expenses. Accrued just means that it's steady building up, but it hasn't been paid yet. So in other words, you have accrued expenses, you have expenses that maybe piling up and you haven't paid them. So, go over those different types of, accounts, C accounts. Then work on, which side do you debit on for increase, which side do you credit on for increase, which side do you credit on for decrease, so sometimes it's good just to read over, chapters. Sometimes you might have to read a chapter more than once. So, let me go over, and this one right here, I just went over this one. Okay, this one young lady, she purchases on account office supplies for $350. Excuse me. So if you purchase office supplies on account for $350, that will create an accounts payable. See, when you create an account, when you're paying and you're creating an account and you're not paying, but you're not paying right away, but you still have to pay. But if you create an account, the store, a company, and you say, well, you want to sign a credit application. So, say for instance, I want to sign a credit application, and so the book said $350. So, I'm creating accounts payable because I'm not paying it right away. So, but I want to, say for instance, I'm purchasing, it could be inventory, it could be supplies, office supplies, everything. So let's go with office supplies. So in other words, I created accounts payable for $350. I didn't pay for it all at one time, but I'm still increasing my assets, my asset account, supplies, because supplies is an asset. I increased my asset account $350 because I purchased supplies. I didn't pay for it all at one time, but I created an accounts payable. So I created an accounts payable, but for the company, they would be creating accounts receivable. They're creating accounts receivable because they're gonna have to receive the money from me. So on the company books, they will put on their books accounts receivable. But me, I'll put accounts payable on my books because I gotta pay them $350. I purchased $350 worth of supplies. Supplies is an asset. So I want to debit on the left. So I'm going to increase my asset account supplies. So I debit on the left $350. So that's that one. And So like I said, sometimes you just have to get down in your book and study. Because accounting it can be a little intricate. I know algebra is, that's kind of rough too, but I kind of, I did a little bit of algebra too. I studied a little algebra at the University of the District of Columbia, right here in Washington, D.C. But down Australia University, I didn't take any algebra. I did my accounting, my business courses, my computer courses, my law classes. So my major was business administration. So let me see what the next one is. Okay, it says in the book, Smith pays $30,000 to acquire some land. And I can say the same thing, Shirley Cosmetics, LLC. Say for instance, I paid $30,000. I paid $30,000 to acquire some land. So if I'm purchasing land, like I showed you in the beginning of the video, I named the assets. I have land, I have buildings, machinery, your mainframes, your supercomputers. All those are assets. So if I purchase land, I'm purchasing an asset. I'm purchasing an asset. So land, and then if you purchase it for $30,000, then you have to pay for it. So I want to credit cash on the right hand side $30,000 because I had to pay for the land. I had to pay for the land $30,000. So land, I'm increasing my asset account, which is land. So like I said, all assets are debited on the left will increase, credit on the right will decrease. But since this came out of my cash account, see, cash account is an asset too. But this time, I'm crediting on the right because I want to decrease my cash account. You know why? Because I took $30,000 out to pay for the land. So, but I increased my land account. It gives me an increased value of land for my company, Shirley Cosmetics, LLC. I got $30,000 worth of land I just purchased. But I had to take it out of my cash account, $30,000. So that's how I did that. Let me see what we have next. Let me see where we at with the time. Okay, I think I may do maybe two more and that'll be it. It says, gentleman named Smith locates apartments for clients and received $1,900. So a gentleman named Smith, he locates apartments for clients and received $1,900. So he locates apartments. It says he locates apartments for clients and receives $1,900 cash. So if he received $1,900 cash, $1,900 cash. So that's going to be an increase in my cash, in his cash account or my cash account. Shirley Cosmetics, LLC. I received $1,900. Smith received $1,900. Cash is an asset account. A debit on the left, $1,900. So, in other words, so this account could also be owner's equity account too. Owner's equity, $1,900. So he received $1,900 in cash. $1,900 in cash. Credit owner's equity, $1,900. Debit cash. Cash is an asset account, so I increased my cash account. Smith increased his cash account, $1,900. I'm going to do one more because I'm at an hour. Let's do one more. Let's see. Okay, the business sales office applies to another business for $150. So my business sold. Say, for instance, my business sold $150 worth of office supplies. It says 150. It says the business sells office supplies to another business for $150. So I sold So that would come under cash. I would do cash and office supplies. So I sold $150 worth of office supplies. So if I sold some office supplies, but I sold it, so that means I increased my cash by $150. I increased my cash $150. So if I sold some office supplies, I increased my cash because I gained $150 from another company. So Shirley Cosmetics sold $150 worth of office supplies for another company, so I increased my cash account, which is an asset account. I want to debit on there for $150. And so since I sold some office supplies, I want to debit my office supplies because I'm decreasing my office supplies because I got rid of some supplies. So I would debit office supplies on the left. Now, if I was going to increase office supplies and purchase office supplies, so actually, I think I will credit office supplies because office supplies is an asset. So if I was going to increase office supplies, I would debit on the left. But I'm not increasing office supplies. I'm getting rid of some office supplies to another company. They purchasing office supplies. They paid me $150. So $150, I'm increasing my cash account, which is an asset account. So I'm going to credit office supplies because I'm getting rid of some office supplies. I'm not increasing. I'm getting rid of them. I'm going to credit office supplies $150. So, I'm going to stop right here because my board is getting a little messy. I'm going to have to clean this board up. So, like I was saying, when you're dealing with accounting, so start out doing your little reading. Just remember the initial accounting equation. Assets equals liability plus owner's equity. So the initial equation, accounting equation, assets equals liabilities plus owner's equity. So in other words, you take your assets, whatever they are, your machinery, your buildings, your land, they supposed to equal whatever's on the other side of this equal sign. So when you take your liabilities and minus it from your owner's equity, it's supposed to have the same total. It's supposed to equal up to the same amount of your assets. So that's what they mean. Both sides supposed to be equal. So in other words, assets over here, assets on the left, equal sign in the middle. When you take your liabilities and minus your liabilities from the owner's equity, it's supposed to be equal to the assets on this side. So in other words, this side, and this side are supposed to equal. So assets equals liabilities plus owner's equity. So, like I said, in the beginning, when you're just learning accounting, I think it's good to, before you even get to the T accounts. So what we did, I went over the terms. You go over the terms. Assets. Then we have our liabilities. Assets, liabilities. You want to go over what is the revenue. What our revenue. What our revenues. Liabilities. You got assets, liabilities, revenues. You want to know what owner's equity is. So assets, liabilities, and then also you want to know about what our accounts receivable is. Accounts receivables, accounts payables, expenses, have assets, we have liabilities, we have revenues, we have owner's equity, we have accounts payable, accounts receivable, accounts payable, expenses. We have accrued expenses. So some of these terms I'll go back over in my next video, but I want to close out right now, clean this board up a little bit, and so just go over definition, assets, liabilities, revenues, owner's equity, whatever, how much equity you have in the business. In other words, Smith invested $50,000 in the business on a debit on the left, on the debit my cash account on the left, credit owner's equity, $50,000. So he had $50,000 of equity in the business. So Shirley Cosmetics, same thing. Any company that you start, you want to create a bank account for the company and the company name. So you never want to commingle your funds. So when you deal with a business, you want a personal bank account. You want your personal bank account separate from your business bank account always. So do a little bit of reading, and then I'll look up in my book and see what lesson plan I want to present in my next video. So like I said, assets equals liabilities plus owner's equity. So last time, just read up on these terms: assets, liabilities, revenues, owner's equity. There's other terms in here in the book too. Also, you go to YouTube and look at other people's videos, and they have a lot of accounting videos, so I may present my lesson in a different way that they present theirs. So check some other videos out, some other accounting videos, so check them out, because we all may present our lesson in a different format. But basically, everything is similar. Assets equals liabilities plus owner's equity. That is the initial accounting equation. And they're going to say the same thing. They're going to teach you about assets, liabilities, owner's equity, revenues. You got your expenses. You got accounts receivables, accounts payables, expenses, accrued expenses, and a whole lot of other terms too that I'll probably be going over, because we have the cost principle or the reliability principle. Some cost principle, when, in other words, you purchase say for instance, you purchase a building, a house, land, or whatever, you have to put it down. You have to put in your books the exact amount that you paid for that. You can't say, well, like the realtor say, well, it's worth say $5,000, but you pay $40,000. No, you have to put down $40,000 in your books. See, when it comes to accounting, everything has to be accurate. Books have to be accurate. Your income statements, your balance sheets, statement of owner's equity, statement of cash flow. So all those have to be accurate. So I want to close for now for the day, and I want to say thanks for joining me. Glad you could be here. Glad to see you. Glad you could join me. And join me on my other videos where I present my Shirley Cosmetics. I could say my entrepreneur series, my entrepreneur segment. Join me on those videos as well. So, comment below, subscribe below. Give me some ideas on what you may want me to talk about in my accounting course. I don't mind doing it. So, I'm not an accounting teacher. So, just trying to give you a few of the basics and the way I learned it. I learned it by learning these terms first, the accounting equation first. Assets equals liabilities plus owner's equity. Then I learned the terms. Then they worked us through the T accounts, and then basically it's basically reading and studying just like anything else. So, and then the T accounts, I went over some of those. So I want to say thanks for joining me. Glad to see you. Glad you could be here, and I hope to see you on my next video.